What's up, YouTube? It's Todd Horst here with tastytracker.com doing a quick video about spare cash. So when I got started out, I didn't put enough spare cash away, and I really didn't get the necessity. People didn't really stress how important having part of your account available was, and it's something that I figured out over time. And then you'll hear here or there people talking about keeping a percentage in cash ready to go, but I guess I don't hear enough people talking about it, so I thought I'd do a video. So what I'm talking about, it applies to investing or trading, and I think when you're starting out, you want to invest everything you have. So your mindset is that if I don't have it invested, then how am I going to make any money? And that is true to a certain extent, but on the flip side of that, if you don't have it invested, you can't lose it. So especially when you're first starting out, you're not going to have a strategy that's immediately profitable for you. So if you invest everything, you're going to blow up your account. That's why most people do blow up their accounts. I've been fortunate enough that I haven't blown up any accounts. However, I have had drawdowns that are larger than I wanted at times, especially while I was figuring my style of trading out. But like I said, people will occasionally tell you not to, but you do it anyway because you're excited about what's in front of you. You're excited because it's new, because you see opportunity and people making money, and so you want to be part of that, obviously. But what cash allows you to do is to jump at opportunities. So if you sort of force the market, or force opportunities, force positions, however you want to word it or think about it. If you force an entry where it's not the best setup, but you're just getting into it because you have some extra money sitting around, you're going to get a position that is less likely to win, or even if it does win, the profit, the return, isn't as good as it could be. So if you have cash sitting around, it will allow you to wait for the most opportune setups that not only will be in your favor, but also will yield a larger return. So the next bullet point here is it allows you to balance your portfolio. So depending on your strategy, obviously if you're day trading, you're not going to balance your portfolio. But if you're swing trading, especially if you're always having market exposure, it's generally a good idea to have a balance. And how I do that anyway is by beta weighting against SPY. In Tastyworks, there's a chart at the top on your portfolio page that shows you by default where all your positions stack up if they were in SPY. So it sort of tries to take apples to apples and says if SPY were at this price, then your portfolio would be here and you would win or lose this much, and so on. That's obviously not 100% exact because sometimes the symbols that you're trading on aren't 100% correlated, but it does its best to put all of your positions across all of the symbols into what they would be equivalent, what their equivalent would be in SPY. So anyway, if you're slanted too much downward, your portfolio is overall bearish, and the market has a rally, then you're going to lose a lot more money than what you could if you were to balance your portfolio. So if you see it slanting one way or the other, obviously you're just putting on positions that are or you're looking for opportunities where it would be the opposite of the slant of your portfolio. So obviously, again, if we had an overly bearish portfolio, we would look for some bullish long positions, and that could be with stocks or options, and you could use it just general long positions on SPY, like an index or something like that, or you can just do that with whatever regular positions fit that criteria. Obviously, I wouldn't recommend putting a bullish position on a stock that looks like it's going to go down, but you might look for more opportunities where stocks are going to go up to put a bullish position on instead of putting on another bearish position on something that's going to go down, since you're already slanted to the downside anyway. So anyway, yeah, if you have cash available and your portfolio goes out of balance, you can put on a couple more positions to rebalance your portfolio. If you have no cash laying around, how are you supposed to move with the market? And again, if the market continues to go against what your portfolio is weighted at currently, and you have no cash, you could end up losing all of your positions and you're left with nothing because you invested it all. So yeah, you can either keep some in cash reserve just for a rainy day and future investing, so that a bad month doesn't completely knock you out. And in addition to that, rebalance as you're going along, so that way any given month, as the market moves, you're not getting too far skewed to either side. Okay, next bullet point here is that cash allows you to roll positions, and this is definitely something that new people don't really get into, and I didn't get into at first. And when I did start to learn the concept of rolling options, it wasn't really explained to me how much cash you need to have in reserve to do that. Even if you're rolling for a credit, which is what most people would recommend, but say you have an iron condor, you can only roll either the put side or the call side. You can't roll them all in one fail swoop. So when you roll the put side, momentarily, even if it is just for a minute, you're going to need to have positions in, say, this expiration and next expiration as you roll one half of it over. And yes, it might only be for a minute, but if you have no cash available, you can't roll that position because you can't hold two expirations at once. As you know, with an iron condor, you only need collateral for one side, or whichever side is widest. But because now you're rolling it to the next month for a moment, you have some, and so say you had one that was 6 wide and one that was 5 wide, and you roll the 5 first, you're going to need an additional $500 minus any credits, depending on, but you get the point there that you need some money in reserve just to roll, even if it's only for a moment. And then if you do what I have talked about before with the risky roll, where you're basically just rolling out, but leaving the vertical that's in your favor on the first month, and then opening up selling a new vertical on the new month, then you're going to need even more, because it's not going to be just for a minute that you have that collateral. You're going to need that for a period of time. If any of that sounded too confusing because I went over it too quickly, feel free to comment below and I'll answer any questions. The last bullet point here is cash allows you to start back up. And so I already talked about that for a second before, but if an expiration doesn't go your way because there's a tweet or a company misfires or whatever, and you were too heavy in that company, or if the entire market's down and you were too bullish, then and you had everything invested, that could blow up your account. Similarly, if you're doing day trading, obviously a lot of day traders put a large sum into one position, so it's very, very easy to blow those accounts up. In either scenarios, swinging or day trading, I wouldn't recommend putting everything in position. In one position, always leaving some in cash reserve, and especially as swing trading, you can diversify a lot better than you can on a day trade. But in any case, people blow up their accounts every day. You see it on Wall Street Bets subreddit and things like that, where they lose all of their money. if you have 100% invested, you've just increased the odds of that happening to you basically to 100%. If you only have 50% invested, then you can at least do that twice if you were to keep it the same. But imagine I lose the first 50%, then going forward I would do 50% of the remainder, so 25% of my original account value. So in theory you can go quite a bit depending on how much you started with before you actually blow up your account. Okay, so what I'm actually recommending is to keep 40 to 75% in cash, and I actually meant that in cash, not invested. 40 to 75% in cash, and that sounds pretty crazy, and you can't do that on a stock account, which we'll get to. But when you're doing with options, the benefit of options is that you can use the leverage to make a lot more money. So you don't actually need your whole account invested anyway to have pretty good returns. Okay, so let's read the first bullet point here. As plays near closing, I may add some, so I get closer to the 70% invested. So that would be 30% in cash. But I only do that with the idea that in the next day or two, assuming the market stays relatively flat or the course of what I'm expecting, then those one or two positions or three positions, whatever, will come off and get me back down to the 50%. So I try not to have too much overlap, if any. A lot of times I like it to get back down to 50-60% in cash before I turn around and reinvest those. And if you think about it, that makes a whole lot of sense, because if you're playing positions that are not neutral, so they're bullish or bearish, and you have positions come off that were successful, so say I have several bullish positions, the market rallies and goes up, and a bunch of those positions pop, and I take them off. Do I really want to open up a whole set of new positions at this elevated, or wait a day or two, most likely for a pullback, and then I'm going to enter? So obviously the latter makes a whole lot more sense. I'll wait for the pullback a day or two later. I don't give it an insane amount of time because then you could potentially be waiting forever. But on a down day, I like to enter my bullish positions and vice versa. Okay. Again, if you do this now, one event will be able to take you out, and you can live to trade another day. Everybody talks about the 90% of people that fail, and really that amounts to the people that lost all their money or got fed up. And so if you still have some money, then you can still play around and hopefully find that methodology that's successful for you. But if you blow up your account, obviously you're going to be less inclined to throw another couple thousand at the market because you're thinking you're just going to lose that all again. Anyway, so should point out that if you listen to basically anybody that's successful, they talk more about maintaining their portfolio and preserving it as opposed to growth. Obviously, they're interested in making money, but they want to preserve what they have more than anything else. So I think that's an important takeaway with why you should keep cash on hand. So the next bullet point, obviously growth is slower. And I said that's the reason we do options instead of stocks. But again, would you rather have a position pay you $100 consistently and only risk losing $200 or $300 in the case of selling credit spreads, and you do that on 50% of your account, or you could choose riskier positions where you buy a lot of calls and put your whole account into it, or even if you are selling credit spreads and you do your entire account, and then you have a bad month and it blows you up. I mean, I think of the two, anybody would rather grow slower than grow faster but have a significant chance of blowing up their account. It just doesn't make sense if you actually intend on doing this for any period of time, which is what you need to do. if you want to be profitable. Obviously, I said already that options, you can have a super small account. So if you want to day trade stocks, it's really good to start with 20,000, in my opinion. Um, but to sort of make it worth your time, but obviously that's a lot of money you're risking. So when you're practicing, if you're not um, well practiced and you haven't spent a lot of time, then you're going to end up losing all that money. First of all, second of all, most people don't have that kind of money sitting around that they can invest. Um, but with options, you can really start off with 2 to 5,000. I think five is great, and actually, I'm starting to really like my $10,000 account a lot better than my $5,000 account, just because of this very topic that I can have more cash on hand to open up 2 or 3 positions when I see an opportunity. On my smaller account, it's harder to stay to keep this cash margin, and then if I do, even still, it really only affords you 1 or 2 positions, so you can't really take advantage uh, to the best of your abilities with a small account. But anyway, that's a different topic. I think the cash thing is really, really important too, because everything is time based. With stocks, if the market tanks, you can obviously hold your stocks forever, and assuming the company doesn't go belly up, you'll probably get your money back in a couple of years. With options, depending on what expiration you chose, probably in the next 2 to 6 weeks, you're going to be down to zero. So if you're wrong, you don't have a whole lot of time to recover from that. So I think that stresses how important it is to keep some cash on hand. But even with stocks, it is still true. I have a note here with if Amazon has a really big earnings miss and they drop, I don't think anybody would think that Amazon's going out of business and they're not still a great company. So you would want to invest in that opportunity, obviously buy that dip. But if you don't have any cash on hand, you can't do it. I mean, I know Amazon's a pricier one that most people can't buy outright anyway, unless they're using fractional shares. Um, but but anyway, so while it is still less true, the cash requirement for stocks, it's obviously preferable. And obviously, the last bullet point I have here doesn't necessarily have to do with cash, but with the beta weighting that I talked about earlier. Always ensure that your beta weighted weight matches your outlook on the market. So I've talked about before how I have a little bit of a bearish skew because I do think we're due for a pullback. I don't think it's going to be anything significant. I don't think with Trump in, he'll allow the markets to go down too low. But I do think we're due for a pullback, so I want to be able to capture that. So obviously that's just my opinion, but I have my portfolio weighted to match that. Okay. In closing, share and like if you can. And I do have my broker links, referral links, but I also have my website, tastytracker.com, which I use to track my stocks and options. There's a free demo if you want to go check it out. It doesn't, you don't sign up for anything. You can just click the sign in for the demo account, and it will sign you right in. If you do decide you like it, it's only $9.99 a month. So I think that's a lot cheaper, and continually work to develop and make that better. And then here's my disclaimer. Anyway, hope you guys have a good day, and I'll talk to you next week.